Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope you are able to hear me. Okay. Hi, Maud. Thanks for confirming the audibility is fine. Let me display the PowerPoint presentation. Tracking the forex market together. Webinar part 1 on 17th of February between 9 and 9:45 GMT. We will track the market using a simple market tracking technique using a live market quote page. So let me give the link for the live market quote page. So I'm just taking the FX Street live market quote page. I'll also focus the camera over that and explain to you how exactly the live market quote page could be used effectively. Now currently in the live market quote page, now the GMT time word you come across is 1 hour ahead of the actual GMT. It is 9:02 GMT now. It is trading around 1.3129, 1.3131 is the open, and 1.314 it is the high, 1.3115 is the low. You come across a very narrow spread between the low and the high, and you come across only 2 pips or 1 pip positive net change. So almost flat, and the spread is not even 30 pips or 32 pips. Then in the case of GBP, it is currently trading around 1.5804 and 1.5820 is the high, 1.5790 is the low. Again, the spread is only about 30 pips and it is showing about 6 pips positive net change. And in the case of yen, it is trading around 7902, 7903 area. 7919 is the high, 7878 is the low, and it shows 9 pip positive net change. When Euro, GBP and USD Yen show positive net change, we know that they are making contrarian move. Euro and GBP are showing the USD weakening move, and USD Yen is showing the USD gaining move. So as a result, the US dollar index might not be affected, and you come across the contrarian move happening. In order to handle the yen crosses, Euro Yen has gained about 11 pips and GBP Yen also gained about 18 pips. So that is how they try to do it in the market, handling the majors, the numerator and the denominator currencies differently. In the numerators, they make the USD weakening move, and denominator, they make the USD gaining move. As a result, you find that the market shows fluctuations with regard to the crosses. Now coming to the Dow CHF, it is currently trading around 91.92. 92.08 is the high, 91.79 is the low, 1 pip negative net change is seen. So among the majors, you find CHF is showing only 1 pip negative net change, or almost equal from that of yesterday's US session close level. And in the case of the numerator currencies, nominally they are up and is slightly up by 7 pips. With regard to the commodity pairs, Canadian dollar, USD CAD is trading around 99.60, 99.74 is the high, 99.51 is the low, 7 pips negative net change is seen. And in the case of Australian dollar, it is trading around 1.0768 and 1.0801 is the high, 1.0745 is the low, 13 pip positive net change is seen. So when Canadian dollar is showing negative net change and Australian dollar is showing positive net change, we understand that they are doing the USD weakening move with regard to that of the commodity pairs. But with regard to the majors, they are making the mixed moves. A nominal gain in the case of Euro, GBP and USD Yen as a contrarian move, and a lesser dip in the case of USD CHF when compared to the rise in the case of Euro, and which shows that they do not want to dip much USD CHF, and once they gain the levels in the case of Euro, they are expected to gain the levels in the case of USD CHF as well. Whenever they make the contrarian move among the majors, understand that they are looking for the volume and hence they focus more on the crosses. So you come across a variation with regard to the net change in the case of Euro and GBP. So Euro is showing about 5 pips positive net change, whereas GBP is showing 12 pips positive net change. As a result, Euro GBP is down by about 2 pips. It is trading around 0.8307 area. So 0.8321 is the high, 0.8302 is the low. So they are trading in the middle level. So this is how they handle. In the case of Euro CHF, they are showing positive net change. So depending upon the moves in the case of the 4 majors and 2 commodity pairs, you come across the fluctuations in the case of the cross. So if you understand the crosses well, if you want to understand the crosses well, you have to see the moves in the case of the majors and also the net changes. Then you will be able to understand, are they going to do the USD weakening move or USD gaining move or a contrarian move. Only when there is a contrarian move, you will come across good moves happening in the case of cross. Whenever there is a USD gaining move or the USD weakening move, in all the 4 majors and 2 commodity pairs, that shows that they are focusing on the majors rather than that of the crosses. At the time, it is not advisable to take positions in the case of crosses. You may not be able to get good profit. So let me go back to that of the PowerPoint presentation. Okay. Now, before going to that of the market reading, we need to understand the market timings. So from that of next month, we'll come across the daily saving system could be incorporated end of next month. Until such time, this is going to be the time followed. This is the time followed by that of the players. 0030 to 7:30 GMT is the Japanese session. 78 is the gap time. Then European session is 8 to 14 GMT. 14 to 14:30 GMT is the gap time. So now we are around 9 GMT now during the European session. And after start of the European session, 1 hour is gone. Still, they are not breached the low in the case of Euro and GBP, even though the spread is very less. And since they are handling the crosses to start with, later on they are expected to handle the majors. So we will try to take the position when the market is closer to that as a low. Then afterwards, again, I will come back and present the part 2 of the webinar between 14 and 14:45 GMT, 30 minutes of the gap time and 15 minutes of the session. I will try to explain to you how the gap time trades can be initiated. The gap time moves are false moves. They make the move opposite to that of what they intend to do during that of the session. In most of the time, excepting during trend reversal time. So that you can follow it. Whenever we are in the middle of the month, like the second week, third week, they normally make the gap time false move. But during the first week and the last week of the month, they continue with that of the gap time. That again, you can just read and take the positions. It's not difficult. Then US session is from 14:30 to 21:30 GMT. Then after that US session close, you come across the interbank treasury sets the closing price by taking into consideration the last 30 minutes trade, and that becomes the closing price in order to calculate the interest and other aspects. And later on, from that of the closing price, whatever the price currently you come across is being reflected in that of the net changes. So currently, if Euro is showing a net change of say 8 pips, that means from yesterday's US session close level after 21:30, it has gained about 8 pips. That's what it refers to. Then you come across the gap time, a prolonged gap time, 21:30 to 0030 GMT, and that gap time is being used by that of the players to hit the stops. There again, they make all volatile moves. Sometimes they also keep it as a subdued move when the volume is really low, or hold the market and try to liquidate their long positions and try to build fresh long position to take up the market further high. What are the factors to be considered in the market reading? First of all, we have to track the market using the GMT time frame. Because it is a 24 hours market, so GMT time is of 24 hours nature, then it is easy for us to identify what they are trying to do in each session. What the session timings I have given it as the Japanese, European and the US, and it may not be coinciding with that of what the times conventionally being followed, because these are all the timings followed by that of the players and not me, followed by that of the players. So we have to necessarily use such timings in order to understand their intentions. So how to read their intentions? First, to track the market using the GMT time. Then identify the sessions. There is a gap time before the start of the session and the early session, the session start time. That is 1 hour and 30 minutes from the start of the session. Suppose European session starts by 8 GMT. Up to 9:30 GMT is the early session. Then the last 1.5 hours, the session gets over by 14 GMT. So from 12:30 to 14 GMT is the late session. Then in between, you come across the mid session. In the mid sessions, they handle the crosses. And during that of the early session of the start session and the late session, they handle the majors. So if you want to trade in majors, focus only on those times. The rest of the hours you take rest, you'll be able to really trade well without straining much. Then you can use the live market code page. I have given the link. This was the link I was giving it, and they had just discontinued because they found that this link is being extensively used in order to read the player's intentions, so they are discontinued. So you can understand the power of the players. Make a note of the high, low, and net change and compare the market. And that is what I showed it in the live market code page. The high and the low, what you come across is currently in the case of euro. Let me go back to the W. Okay, currently you come across euro is showing a high of 1.3148 and 1.3115 is the low, and currently market is closer to the high. 3148 is the high, 3139 is the current level. Similarly, in the case of GBP, 5825 is the high and currently trading around 5823. Again, getting struck. Try to refresh it frequently. Now let me go back to that as a PowerPoint presentation. So once you relate the market, that is the high and low and also the net change, whether it is positive or negative, and you identify the currency which has made more than 40 to 50 pips spread between the high and the low. As I explained in the beginning that none of the currencies have made spread more than 40 pips. So we will not enter in the market just like that with a bullish or a bearish feel unless and otherwise the spread gets increased. If the spread is not increased, then that means the players want to hold the market and then subsequently distribute the positions at a higher level, and they are not expected to make any good headway. So unless and otherwise they make the spread between the high and the low, even if they make a swing, you'll be able to get about 30 to 40 pips. Otherwise, if you enter into the market, you might be able to get about 10 to 15 pips. So instead, we can wait for a good opportunity. When they make a downward stop and we'll try to take a buy, or when they make an upward stop and we'll try to take a sell. That sort of trade you can initiate once the spread becomes more. Then watch whether the current levels are closer to low or closer to high. Currently, you find euro and GBP are closer to the high, and USD yen is also closer to the high or slightly below that. And in the case of CHF, it is closer to the low or slightly above. Then Canadian dollar is closer to low, Australian dollar is closer to the not closer, in the middle level. So avoid taking positions when in the middle level. Australian dollar is in the middle level, so avoid taking position because it is not going to make any quick move for us to quickly grab the profit. So how, after reading all those things, how to take an entry decision? Whether the spread is more, we have to first of all see whether we are during the start of the session or late session in order to take the positions in that of the majors. And if you want to take positions in the crosses, then we can choose the mid sessions of mid Japanese, mid European and mid US sessions. So when we decide to take an entry within the session we wanted to close, we can buy near that of the low or sell near that of the high when the low or high are not breached in 30 minutes from the start of the session. So 8 GMT they started the session, 8:30 they are not breached the low in euro and GBP. So what is going to be our objective? The next dip when they come closer to low, we'll try to take a buy position. and try to close within the session when they go closer to high or breach the high by using a trailing stop. So along with that of the market reading, we need to use the trading strategy in order to successfully earn in every trade. So we may technically derive, okay, this is the entry point because it is slightly above that of the pivot. A strong pivot is support, or you can say a strong support is there around 1.3115 area. So we can try to take a buy. We can take such decisions based on various type of calculations, but still the players are very cunning. They can simply make a downward stop and below that level for about 30-40 pips and go up. So in that process, if you keep a stop, then they could hit the stop before you try to see a profit in your position. The position will be closed. Sometimes what happens, people keep the hedging order, they hedge your lower level sell and go up. Then you get stuck with hedging and you say that, no, hedging I'm not familiar with, or it is not very useful tool for me. That sort of decisions you take it because you are not able to read the intentions of the players. The players have got a very clear-cut intention of trying to hit the stops of the traders and earn money. It is an open secret nowadays. Everybody is talking about that. So in such a scenario, it is not advisable to just to trade without a stop. So you may try to trade without a stop thinking that if I keep the stop, they can hit the stop. But they have another technique like margin call. Last week Euro was trading around 1.33 and GBP was around 1.5859 area, and many would have taken a buy position thinking that for the rise could happen and without a stop. So what the players have done, they have dropped Euro to 1.30 area and GBP to 1.57 area. So automatically the margin pressure will come in. So if you are not keeping the stop, they are not going to spare you. They can just give the margin pressure for you and make a move against you. As a result, it can lead to margin call. So don't think that stop hunt is the only tool by which they try to earn. They also use frequently the margin calls. How the margin call is affected? They drop very quickly, and once your positions are out of margin, automatically the positions will come for selling, and they try to keep a higher level buy order. Straight away it will absorb all the sells which are coming at the lowest level. So yesterday you would have noticed that 1.30 area, they have been accumulating Euro like anything, and nobody was in a position to understand why it is holding at 1.30 when the Greece resolution is not being seen, and it is likely to go to 1.29, 28, 27, 25 and things like that, but they are taking it up. So when people become bearish and try to sell, they buy. When the people become bullish and buy it at the higher level, they give it to them. And they are doing sensible trade of buy at the lower level and sell at the higher level. We, in the name of technical trades, buy at the higher level, aiming for further rise and stop it out at the lower level. So you can understand who is having a better trading strategy, whether the players or the traders. So ultimately, your trading strategy is going to help you from such a scenario. So you won't be knowing whether all the traders are long or all the traders are short and things like that. People may say about the CORD's data and things like that, but that is not totally reliable. It is not talking about the entire volume of trading. So invariably, you may come across that wrong publicities might be there, or highlighting might be there that traders are all long, traders are all short, and things like that. If we try to use it every time, then you may find that some trades might go well, some trades may not go well. So ultimately, a reliable method is whatever be the hidden agenda of the players, they have to disclose it in the market. They can't keep it as a closed card all the time. So if they want to rise the market, they have to first of all make a downward stop and before making a rise. And similarly, if they want to drop it, they make an upward stop and before making a drop. So identify the type of moves they do. They make a downward stop and try to buy along with them. They make an upward stop and exit out of the positions. So whenever there is a quick move happening in the market, try to enter and exit. When they are keeping in a subdued level, just watch the market without any position, so that you don't have any tension and you need not pray to God all the way that, come on, God make euro to go up? How can God can come and help us in this way? Because ultimately the players are making the moves. It's a man-made market, so obviously the players have to move. So we have to patiently wait. And whole of yesterday, you would have noticed during the European session, they have been doing the patient testing game, keeping euro around 1.30 and just breached it to 1.2975, 35 pips breaching in a whole of about 12 hour scenario. And that is how they test the patience. If you are committed already in the market, then you have to patiently wait for 12 hours. You cannot attend to any other job. You try to keep stop and you might be at the risk of the stop being hit. So to avoid all those things, whenever the spread becomes more than 40 to 50 pips, when the market is closing to low, you can try to take a buy. I'll also explain about the technical trade, how exactly it has to be done. It is not that always we try to buy near that of the low. Players may not keep it near the low all the time. And they may rise above that of the high and keep above that of the high for more than 30 minutes. In that case, you can do a technical trade of buy above that of the high. They sustain above that of the high for more than 30 minutes. So for that, the type of moves are very important. I'll explain with the help of the next slide. So once in the basic trading, you try to take a position, you keep entry stop of 30 pips. Okay, use entry stop of 30 pips, and once the position makes about 20 to 25 pips profit, keep stop at entry and remove the hedging order or the stop. So that way you do the money management first before making earnings from the other market. You try to see that you don't incur any loss. See, ultimately, many of the traders become addicted to trading only when they continue to lose money. And those who are really consistently making money, they don't hold the position for a long time. They wait for the quick opportunities and try to grab that opportunity and earn in a matter of about 30 minutes to 1 hour or 2 hours. When the spike is over, they exit and just attend to other work. So that style of trading, you need to develop it. For that, the most important thing is whatever the entry you use, whatever the type of studies you use it to derive the entry, you try to keep stop at entry once the position makes profit. And also try to see that you are using the stop of 30 pips or a hedging order of 30 pips. If the stop is filled, doesn't matter. Your loss is limited only to 30 pips, which you can absorb. Then wait for 30 minutes to 2 hours after identifying the type of moves they are doing it. Then you'll be able to see in the next trade that lost money can be earned. But immediately if you try to think that, okay, market has become bullish, so I have taken a short, so I turn long and try to buy it, then they will drop the market and make you to lose the money again. Because market means swings. When their spread is not more than 40 to 50 pips, they are not going to make a trending move in the market. They are expected to make only a swing between the high and the low. In such a scenario, to try to do that sort of reversal trade, and it might be hurting you again. Similarly, with regard to the exit, equal to that of the entry, exit is also important. How exactly the exit has to be done? When you have got a buy near that of the low, then when they go closer to that of the high and not breach the high, or breach the high and in 10 to 15 minutes they stop cutting the high and start coming down below that of the initial high, you just exit out of the position. And they wanted to make a swing on the downside again. You can take a buy again and try to book profit. So that aim for a small profit to start with, build up your equity, then you'll find more and more consistent profit earning trades happen in your account. Then you gain the confidence and you are able to develop the sense to read the market. Otherwise, you expect always somebody else to read the market and give it to you. If there's somebody else give the right direction about the market, you appreciate it. And you just say that I earned about 30 pips, 40 pips because of you and all those things. Once the position makes loss, you start yelling at him. That means you are another man's man. And you don't have your own sense of responsibility and the sense of understanding of the market. Because others can guide, but there can be always an element of error involved. Because all are human beings. When we try to do the analysis, there can be an element of error. Next time we can correct it, but the damage cost is damage cost according to in your trade. So you have to understand that. So the risk eliminating strategy becomes a must in every trade. Then you will see that your usable margin is not getting eroded just like that. So avoid impulsive decisions like buy during rise and sell during drop. And you may come across later on that you happen to be the lowest level seller or happen to be the highest level buyer. And that happens once you become impulsive. After becoming impulsive, you find in order to just control the damage, you become more and more impulsive and try to add more positions. That leads to overtrading. And when they make a trending move against you, then you find that you are really taken too many positions and you are not in a position to come out of them without realizing a loss. So if you avoid cutting the positions and try to hold the position, praying to God that the market should give me profit and things like that, you find that either the positions are closed with a margin call, then you go bravely and open another account and you try to say that somehow I have to earn it from the market. But that sort of emotions are not being respected by that of the market. And I always say market rewards pace and not impulsiveness. Because out of experience of nearly about 18 years in the market, I have seen every market will come across such a scenario. The impulsive traders are the target of the other players. So if the initial high or the low is breached, today they are not breached the initial high or the low. In case if they breached it, identify the type of move. I explained on a daily basis during Asian session live market analysis about the type of moves, what are the sequence of moves they try to do it. Stop and is the move, they go above that of the high, initial high and come below that in less than 30 minutes or below that of the low and come above that of the initial low in less than 30 minutes. That is stop and. False move, they go up to that of the high and come down, reverse it, or up to that of the low and reverse it. And that is as a false move. Once they finish the false move, they continue with the extended move. So they make a stop and during session start time. Before making an extended move, they make a false move. And during false move only, I said that you can enter into the market. So what is false move now? Suppose if they want to rise euro, then what they do? They come down up to that of the low, pretend as if they are going to make a stop and below that of the low or come down below, and without breaching the low in 30 minutes, they reverse and go up to that of the high quickly and breach the high and stay above there for 30 minutes. That means for another 2 hours, they wanted to make an extended rise. So once you identify a downward false move, you take a buy. And when you look into that of the chart, when it goes above that of the high, you find that the demand is created using the chart. Then you try to buy there, you will be able to book profit. But if you want to really maximize the profit, identify the false move and when they are closer to low, not breaching the low for 30 minutes time, during the mid session or the late session, you try to buy there. Keep the hedging order to limit the risk. And once the position makes profit, keep stop at entry. Once they go above the high and stay there, understand they wanted to make an extended move for 2 hours. Calmly wait for 2 hours and then you find the last new high. Every 30 minutes they will cut the high and go above. In the last 30 minutes they will stop cutting the high. Exit out of the position. Then they wanted to drop it again for the next session. So that is the extended move. It can happen on the downside as well. Then intentional move. Yesterday they had done the intentional move during that of the Japanese and the European session. You know that Euro was slowly making the slide, cutting every 30 minutes to 1 hour, then new low, low, and coming down all the way to that of 1.30 and below by late European session. So intentional move is for 2 sessions and the start of the 3rd session. The start of the 3rd session, they came down to 1.2975 and started reversing it. So once you identify the move is intentional, they start cutting the low, then don't take a buy in a hurry. You wait for the third session start and then buy to the closest, lowest level. Then they make a very quick rise from there. You earn substantial profit out of that. Rather than in the session start time itself, you try to buy. How you identify the intentional move? When they breach the low and not coming above the low for more than 2 hours. When they breach the low and go below, not coming above that for more than 2 hours, identify it is an intentional move for 2 sessions and the start of the third session. Just go and take rest and come back by the start of the third session, try to take a buy. You need not even bother about what is going to be the type of data which is going to be released. You'll find the market will go up. Still the uncertainty, the Greece problem, everything is continuing, but the players started gaining the levels. Because they cannot keep quiet. If they keep quiet at one level until the resolution is formed, they cannot earn. The money has to be earned consistently. So they cannot keep quiet. They have to make swings in the market. So they are focusing on the money, but we only focusing on the various type of economic developments and worry about the various countries. And even the topmost financial people also, and who have got the powers to change the financial economic conditions of the country, they are not even worried. But we traders worry about the economic conditions of it. So that is why you find that they negotiate, because everybody is trying to stand on their own leg, and they try to see that their approach is the best in order to get the economic recovery. So that is how you find in the world situation happen. And we worry about the unnecessary things many times. I'm not trying to criticize that. I'm trying to tell you, you can learn about it. You can just identify what is the current market sentiment, etc. But don't be moved with that. Once you become emotionally involved and try to say that only God can save euro or only God can save US dollar, if you try to think like that, you become emotional. Then later on, you try to go with that of the market sentiment and try to sell when euro is around 1.3020. Later on, see that you are incurring a loss. So there are so many talks in the market about the European crisis, but if you try to sell, you incur a loss. And so when the market is near the high, if you make a sell, you will be able to book some profit. When the market is near the low, then avoid doing it. But if they breach the low and stay below the low like yesterday for more than 30 minutes and more than 2 hours, you can take a sell below the low, initial low, because they want to drop further down. But that will be relatively a risky trade, because if you fail to book profit when they are reversing on the third session, then your position will be making loss. So technical trade, we should try to close it within the same session or during the gap time. Then the trades will work very well. So extended move is for 2 hours and the intentional move is for about 2 sessions and start of the third session. So whenever you come across quick moves in the market, try to enter or exit, or the spread becomes between 40 to 50 pips. Less than that, avoid it. Then you come across the last one as the extended stop point. This they do it during the trend reversal times, during first week and the last week of the month. Suddenly they rise above that of the high, about 150 pips, and drop and continue to cut the low and come down. That is extended upward stop point. Similarly, an extended downward stop point, from that of the high, they come to low and breach and come down 150 pips below and reverse within a matter of 1 to 2 hours or by the next session and come to that of the initial low and breach the high and go above. That is extended move. That you can anticipate during trend reversal time. So suppose if they want to rise the market and you are holding a buy position around 1.27, what they do, they try to breach or go to 1.26 and hit your stop or create a margin call for you and then go up. So your really profit making position will be kept with a loss, and later on the market might be moving in your expected direction. So this they do it whenever there is a trend reversal time. I am giving in my forecast every time when exactly the extended stop loss is likely to happen, so that you will be able to avoid holding a position without a stop at that time, or use the hedging to limit the risk. Otherwise, when they make such extended stop and after the downward stop and try to buy, you will become the richest. Straight away you can see about 200, 300 pips profit in one single trade. I don't have much time to explain about the hedging here because I explained more about the psychology related to trading. So hedging is used instead of stop whenever you have the hedging facility in your trading platform. The hedging is continued trade when the market moves in your favor. You keep the hedging order. If they have filled the hedging order and come down, then you wait for the market to come and close your hedging at entry, stop at entry. Then they continue rising, then participate in the market. So it can help you that way. Hedging can be used for either way trading. When during the trend reversal time, they will make very quick move, or during mid-week, they make either way stoppers. During that time, if you are hedged, book profit on the buy side, book profit on the sell side. Then hedging can be used to reverse the trade. Suppose you have got a buy and the hedging is continuously making profit for 2 hours. You know very well they are going to make an intentional move on the downside. You close the hedging with, you close the original position with 50 pips loss. The hedge position will be making 20 pips profit. And when they drop another 50 to 70 pips, you will come across a net profit trade on that day. So identify that move. If they are continuously, if the position is making profit for more than 2 hours, then try to just cut the original position and make the profit out of the hedging. And if they just drop only up to 2 hours and stop cutting it, book profit in the hedging and keep another hedging order below. You will rise the market and reverse, and you try to trail the hedging order until you are able to keep stop at entry. Then try to book profit on the buy side as well. So for all this sort of hedging trading, you require the understanding of the type of moves the player is making in the market. Then hedging is also used in the event of emergency. In case if you want to leave the trade and just attend to some other family work, you can just hedge the position and try to leave it as such. And one back you can continue trading it, because as I explained, if the hedging is making profit, you can just cut the buy position and book profit in the hedging. Or if the hedging is making loss, you can cut the hedging and try to book profit in that of the buy position. And cutting the loss in the hedging doesn't mean it will incur a huge loss. The difference between the buy and the sell is the only loss. So if you just close the hedging with 70 pips loss, your buy position will be already making 40 pips profit. Understand that. So any level, even if the hedging is making 200 pips loss, your buy position is making 170 pips profit. Then you understand the real trend, close the hedging. You find market moves on another 30-40 pips, then you are at break even. When they continue to rise upward, you continue to make the profit. So hedging can be used to close the position any time frame instead of stopping out a position during uncertainty. If the market is not making an upward or a downward move, you simply hedge the market and just watch the market which way they want you to make it. And you can open out the ledge and continue trading. Hedging can be used to spread the risk with limited risk in each position. So suppose you want to do the averaging. In each position, try to keep the hedging order, so that when you spread the risk of about 100 to 150 pips on the downside, when they are dropping it, then you buy, still it is hedged. Then what happens during the trend reversal time, during the month end, you close all the hedgings with a profit. Then they reverse the market for the next month and go up and trail the hedging order for the rest of the buy positions and sell the buy position above their average. Simple. All trades will be able to get the net profit. And these are all very easy type of trading. Hedging can be used for breakout trade. It's very essential because sometimes they do the breakout and suddenly reverse it when all turn long. Then hedging is the most vital thing of the situation. So that you can close the highest level buy, continue making profit on the sell side. Then hedging can be used without additional margin because most of the platforms, they don't charge additional margin for the hedging. So in this session, Euro and GBP are expected to swing and rise. They are already rising. If you notice it, so what position you can take there? Cut the high in the case of Euro and they have stayed above. So let us do a technical trade. Sorry, I was explaining the concept more rather than trying to take the position and trying to show profit in that, because it is not that I trade successfully, you become happy. You have to trade successfully to become happy. So that is why I have taken much time to explain to you how you can perceive the market. So as I explained, in first 30 minutes, they have not breached the low of the session. That means they wanted to rise. So that is what they are doing it. So in that, they came closer to that of the low as a false move in some of the pairs and started rising it and cut the high and staying above that of the high. So what is what is the next move? Extended move for 2 hours. If they continue to cut the high for more than 2 hours, it is an intentional move rise throughout the day. So they started cutting the high during that of the European session. So at least 2 sessions, and start of the 3rd session, they have to continue to rise. So European session they have started, so US session also they are expected to continue the rise. In case if they cut the high after 2 hours. Currently the time is 9:42 GMT, and they cut the high by 9:40. So when they cut the high by 9:40, you have to wait for 2 hours from there. And if they continue to cut the new high, that means it is intentionally move. Otherwise, they may drop again to that of the high, make a downward stop and around that of the high. If there are technical traders having a stop below that of the initial high, because it is not difficult for them to identify where the cluster of stops are, because they physically know it, where the cluster of stops are, and try to hit it. They don't require any technical analysis to know where the stops are. And they propagate the technical analysis world over free, so that all traders will follow and try to keep the stop below such supports. Then easily they hit the stops and go up. So Euro 1.3161 is the current level, and they went up to 1.3170. So we will try to keep in the middle level or closer to that of the initial high, 1.3147, a buy. With the entry stop of 30 pips. Then GBP again, they have gone to 58.53 and 58.42 was the initial high. So we keep it around that. Just 2 pips above that. So I'm not taking any risks. As soon as I decide upon the entry, because it becomes a technical trade now, they already gone above that of the high and gone from the new high and come down a little bit, but still not breached the initial high and come down. So that means it is not a stop. It is an extended move they wanted to make. So we have to see whether they make a false dip again before going high. At that time we will try to take a buy. So we will not become emotional and try to take it at the market. We will keep limit order just 10 pips below the market and see whether they are filling it. If they don't fill it, then we modify and try to buy it after 30 minutes at a higher level. Because we know that they don't want to drop and that they have trapped the short sellers. So they don't want to dip and give profit to that of the short sellers. Then they continue to rise. So in the market, there are only 2 types of traders, namely the buyers and the sellers, whom they are trying to trap. We need to identify whether they are trying to trap us doing a buy and sell trade or trying to trap the short sellers. If you identify that, who is trying to make profit, in that you can easily understand whom they are trying to trap and stop it out if in case if they are making the move against us. So instead we use the hedging order, because in European trading platform the hedging facility is available. Keep 30 pips below that of the market, the hedging order, below the buy position. And in case if they hedged, then you handle the hedging by watching it for 30 minutes. In 30 minutes, if the hedging is not making profit, that means they only hit the hedge and gone up. So that is why the hedge sell is not making profit. You close it with about 5 to 10 pips profit, loss, and keep another hedging order 30 pips below that of the market and try to trail it up as they gain the level. In case if the hedging is making profit for 30 minutes, understand that they are going against us. So identify whether it is an extended move or intentional move. They stop. If they continue to cut the low for more than 2 hours, then it is intentional move on the downside. Otherwise, it is only an extended move up to 2 hours. Afterwards, the last 30 minutes, they don't cut the new low. Then you try to close the hedging with a profit and keep 30 pips below another hedging order to limit the risk. And when they start reversing, the market trail the hedging upward so that you will recover the usable margin again. Then once they come above that of your buy position, you keep stop at entry so that on the sell side you have booked profit. If it is closed with stop at entry, still you are in profit. And in case if they rise further up, then book profit on the buy side. Only when you have positions you will be able to earn money from the other market. Theoretically we can talk so many things, but only if you have positions you will be able to earn from the other market. But if you use the stop, both the positions are closed, so you have to think of a fresh trade. Whereas when you use the hedging, you hold both the positions. You have higher level buy and lower level sell. Think like a short seller, how exactly to handle the sell side. And think exactly like a buyer, how you can close the buy with a profit. So do the two trades separately. You will not feel that you are really struck with it of the hedging. It is a question of mental perception. So these are all the two trades. I just entered it, and not much of a time is left. So let me try to answer to that of the questions. You can make note of it and whether those things are filled. If it is not filled, I'll try to modify and try to take the positions of the market. I can modify only up to about 10 pips or 12 pips maximum, not more than that. Otherwise, I'll wait for the next opportunity during the next session. So we will not chase the market. To chase the market chases us away. So let me minimize the PowerPoint presentation and try to keep the camera focused over that of the live market code page. Again, it is get loaded, and meanwhile I'll try to answer to the questions which are asked here. Yesterday we were able to understand and apply the methodology that we taught. We waited till the European session. After 1.5 hours in the US session, we entered the market. Okay, fine. So it is very easy. If you learn it properly and enter into trade, then it becomes easy. If you try to make it as a costly experience after bad trades and try to learn it, the bad trades will be lingering on your mind for you to do the real trade quickly to earn back the lost money. Then your learning does not happen perfectly. Once you have not learnt it perfectly, then you continue to lose the money. These are all very, very simple concepts and it works. And if you watch it, you need not even look into that other chart. Simply you can just watch the live market code page, see the current price action and try to identify what sort of moves they are trying to do it. Use the time frame to decide when to enter and when to exit. The charts and the other technical analysis give the same. But instead you can just use the live market code page and make it very, very simple and decisive trading. Then grow. Today, as it has a small spread, there will be only swing trade. Yes, until such time they increase the spread. Now they increase the spread between the high and the low. In this code page, the high is not been altered. Current level is 1.3163, but it's showing the high as 1.3148. I think something wrong with the code page. I just refreshed it. I request Mod to really look into it and give me a good code page, please. Then J. Regarding hedging, once the position is hedged after the original buy position had dropped 30 pips. So do I close the hedge position when price reaches the original buy price, or close the position when the price breached the high and stay there? No. Once you have a high level buy and low level sell, they hit your sell and come up and come to that of the high. Don't close your high. That means the market has hit your hedging order and gone up. And once they go above the high, you understand that they are really wanting to rise it. At that time also you can close the hedging with 40 pips loss. The other way is, when the hedging is filled and the hedging is not making profit for 30 minutes, you can close it straight and keep another hedging order to limit the risk. So your way of trading is, you wanted to see whether that is out of fear. So when position is hedged and you wanted to stop out the original position with stop at entry and then try to earn on the hedge, but it may happen or may not happen. That is not the right way of looking at it. Then regarding hedging, once the position is hedged, okay, again the same question. Incognito, what about just a bank or a corporation is just selling euro and the players cannot absorb the volume? It is just going to go down no matter what the players won't ride. Okay. Now for your information, 2/3 of the volume in the forex market is of the players, and 1/3 is rest of the traders, bank, everything inclusive. You can understand, and you can never say that the players are not in a position to absorb, because the players place the orders through the banks only. So it is a very complicated game. So instead of doing that, we try to understand that it is being manipulated and try to become smarter than that of the players. Nothing more than that. See, after all, they are also human beings. So one can outsmart the other person. And in a competitive world, that outsmarting is the only way to become successful. And not pulling the leg of the other person. So what you have to do is just outsmart by thinking, by developing a tangent idea and try to see why they are doing it, how they are doing it, and what are the techniques they are using it. Because they cannot come from heaven. They have to use the bank terminal to make the trades. And there are a lot of restrictions for bank trading. So understand how they are violating all those things. Insider trading is prevented, but still they do it. No, it is punishable. Still they do it. And in case if some insider trading is caught, and you know the trader who places the order will be punished, and not the person who takes the decision. That is how they just get along with these things. So the richest continue to become richer and richer. Then NG. European session is making high, US session start turning down. No, you can assume like that, and you have to find out the type of moves. Then you can understand whether they are making a rise, continue to make the extended rise above that of the high and stay there, or just to reverse it afterwards, after 2 hours. After 2 hours, if they stop cutting the high and come down, that means they wanted to make a reversal during that of the US session. So that you need to identify. You have to book profit. When they come below that of the initial high, stay there for initial high and stay there for more than 30 minutes during the late session. Understand they finished the extended move and they wanted to make a downward swing up to the low. And once they come there and they up, if they stay for 30 minutes near the low, that means they want to make a false move to make another rise. Otherwise, they want to make a stop and during session start time and go up. Or they want to continuously drop it as well. So that you need to read it rather than presuming it. You can easily read it using my technique, what I explained to you. On a daily basis, I am doing it in the Asian session webinar. And if you try to listen and follow it in your live market code page analysis, you'll be able to really understand it. It's not difficult at all. because a lot of things were lingering in your mind. You wanted to acquire lot of indirect information rather than the direct information. Then you get confusions. Then you go in for the 15-minute chart, 30-minute chart, 4-hour chart, 8-hour chart, daily chart, and things like that. And suddenly jump to 15-minute chart and go to 1-hour chart. And if somebody asks you why you have gone to 15-minute chart suddenly, you don't have an answer. And these sort of uncertainties continue to happen. But if you try to read the players' intentions, and you can continuously trade along with them. Okay, I have just kept the camera over that of the live market code page at the moment. And from Euro and GBP fall on Monday, since it was a holiday news. Okay, next Monday. So I'll explain it during the next session about it, because I'm getting up. Saxo Bank code page will not be back online. No, they are very, very adamant. They do not want to give it. I negotiated with various means, but still it is not happening. Because they identified, by using Saxo Bank code, we are able to identify their signals. So they do not want that to happen, the player signals. Because it is directly from that of the treasury. It won't just stop like this. And lower high is shown when the market is above, and that sort of variations will not happen. Once the code comes from that other bank, then these sort of things happen. Some of the feed providers. Then I will watch under 31.20 now. Every trade you have ever made on that spreadsheet. No, you just watch whether they are coming to 31.20 or 31.47. Just watch and understand. It is not necessary that they have to come to low all the time. If they are trapped the short sellers, they are not merciful to drop it to give profit booking opportunity or stop out at entry for the short sellers. They will punish the short sellers and the long holders alternatively. Then what about a New Zealand dollar? New Zealand dollar is also expected to gain the level now. And you know that Australian dollar has come to 1.080 area. And now they will try to push New Zealand dollar, which is not available in this list. I'm sorry, it is not available in the list. Okay, it is expected to go up. And your theory of proven beyond doubt. We have been using it and giving an FX rate for the past 12 years. And from that of the question answer sessions in 2002, 2003. And Naomi was the moderator at that time, and I have given that, and they are also displayed in FX Street under my profile. You can see that the players cannot change their strategies. If I desire to become a cunning person, and that is the only means by which I can act as a cunning person and try to earn from the others. There is no other method. If I want to grab the money without an effort, I have to first of all cheat you. That's what they are doing it. Jay, you mentioned earlier in the month that euro target for the February is 1.38. Yes, but market is making a very lackluster moves and sideways moves for a prolonged period, but still on the upside. But because of the volume variation and the expected calculated levels are not being achieved. I'm sorry about it. As I explained during that of the webinar, that they are all estimated levels. And there is no guarantee that the market has to reach those levels. But you follow the trend, whether it is up or down. That is what I told you. Give importance to that of the trend rather than the estimated levels. So we do calculate the Fibonacci retracement levels, pivot points, etc. Do you think that market is respecting those levels? They breach. Similarly, these estimated levels can also be breached depending upon the volume variation. Then Mali. Should we buy euro? No. As I explained that you try to buy it near that of the initial high, 1.314748 and 4950. That will be fine. Currently trading around 1.3157. So when they come to slightly lower, we can take a buy. So let me go back to that of the PowerPoint presentation. It's already getting delayed. I'm sorry for that. So I kept the buy order at 31.47 because the actual high was 31.47. And if they go up to that and fill mine, then it becomes a position. I'll keep the hedging order 30 pips below 31.17. When the position makes profit, I'll keep stop at entry. Similarly in the case of QB. I'm looking for that dip, and then they will try to fill the position and then go up. If they hedge me, I will handle the hedging without any fear. So ultimately, when you have these strategies, if they hedge and market goes against me, or if they show profit in my position. So if they show profit in my position, I'll keep stop at entry and maximize the profit. And if they hedge me and go down, I try to maximize the profit on the downside. So either way, let them move the market. I am here to make the money. That sort of determination and the self-confidence is needed in order to become a successful trader. I'll come back by 14 GMT and take the part 2 of the webinar. During that time, I will explain to you what happened to the orders I have placed, whether they are filled or not filled, and what is the fate of those trades, whether I just booked a profit or a loss or hedged and things like that. And later on, I will also explain to you for the trades for the US sessions. And I will also explain, because in the US platforms, hedging facility is not available, I wanted to explain more about how to handle the cross or how to decide with regard to the trades in crosses during mid-session. That I will try to explain it during second part of this webinar. So thank you one and all. See you again by 14 GMT. Please come back. And if you find it is an interesting information, then you can continue to come for these webinars and learn yourself without any cost. And still, you will be able to earn very nicely from the market. Thank you one and all. See you by 14 GMT.